When an investor suffers from short-term focus, he or she inappropriately focuses on short-term risk as opposed to long-term risk. Given today's technology and instant access to information via the internet, it is inevitable that many investors will check their investment performance on a frequent basis. Most investors know why they are investing. They have long-term goals that they are trying to achieve. Yet, they often exhibit very short-term behavior, such as frequent trading and/or overreacting to the short-term volatility of investments. It's imperative that these individuals resist the temptation to behave as if their time horizon were far shorter than it truly is. In a study of retirement plan participants, individuals were divided into two groups, and each group was told they could choose between only two funds, A and B. They were then given some information about the historical returns of these funds and were asked to decide, based on this information, how much of their retirement money they would invest in each fund. The returns for the funds were derived from actual stock and bond returns. The manipulation in the experiment was the manner in which the fund returns were displayed. One group was shown a distribution of one-year returns for both stocks and bonds. The other group was shown a distribution of 30-year returns. The academics predicted that subjects viewing the one-year chart would invest less in stocks than subjects viewing the 30-year return chart. They based their forecast on the fact that the one-year chart accentuated the perceived risk of investing in stocks. They stated that over a one-year period, the likelihood of stocks underperforming bonds is about a third, while over a 30-year period, the likelihood is about 5%. The results found that the group looking at the distribution of one-year returns allocated their portfolios much more conservatively, 60% to bonds and 40% to stocks. In contrast, the group that saw the 30-year return distribution allocated their portfolios more aggressively, 10% to bonds and 90% to stocks. Exposure to frequency of returns tends to affect an investor's tolerance for risk. It's tempting for investors to monitor their investment accounts on a regular basis. Instant access to real-time quotes and a barrage of media reports on daily stock market fluctuations can make it difficult for investors with a long-term investment horizon to stay focused on their goals. In reality, these daily market movements may not be as extreme as they seem. As investors look longer term, their perception often changes. Short-term market fluctuations can be quite volatile, and the probability of realizing a loss within any given day is high. However, the likelihood of realizing a loss has historically decreased over longer holding periods. The graph illustrates that while the probability of losing money on a daily basis over the past 20 years was 46%, the probability dropped dramatically when analyzing an annual time period, about 20%. Periodic review of an investment portfolio is necessary, but investors shouldn't let short-term swings affect their view of the future.